Good evening, it's Doc Severson with the Theo Night Report for Tuesday, January 30th. I'm going to start out tonight with a chart of the S&P 500, and today was the first time we saw any volatility since the bear market of 2017 back here on December 1st. Remember that day? That was it. That was our bear market in 2017. So after markets have become the most extended to the upside that we have quite frankly ever seen and are very comparable to 1987, we've seen a little bit of fear and a little bit of downside coming in. Now, there's a lot of reasons for this. Now, first of all, let's look across the board. One of the reasons for this is because interest rates are driving higher. Interest rates are not waiting for the Fed. They are going higher right now. So on the 10-year note, you can see that this is now above 2.7%. So they're starting to really move. And we have a lot of dynamics across the board now as we've seen the dollar in free fall, but we're also seeing the bonds starting to go into free fall as well too. So we have all kinds of shifts and dynamics that are happening in the market. Now, normally you would say with something like this, what would be the beneficiary of something like this happening if we have interest rates going up, bonds going down, and equities going down? Well, that would be gold, but gold itself is really going nowhere today at all. It did hang tough, but I'm a little surprised that we didn't see strength coming in at this point. Now, I'm still looking at GLD with this ascending triangle pattern here. We could be in for a breakout over 130. So I'm designing a longer term trade that I'm going to set up on that position sometime in the next week or so. Now, my sense is that we're going to see more volatility. We're going to see more intraday and overall volatility in the next 3 days than we have seen literally in months. And the reasons for that are plenty. First of all, tomorrow we've got the ADP jobs report. Not a major market mover, but if it is a big or small number, then what they're going to do is to take this for a proxy for Friday's federal number. Now, not always do we see correlation between the two numbers. However, we have seen the ADP report move the market. Now, of course, tomorrow the big news announcement is the FOMC, which is going to come at 2 p.m. Eastern Time. Now, this is just the minor FOMC announcement. This actually is Yellen's last and does not come with a press conference afterwards. So it's just going to be the policy release, and that's it. But pay attention to the language. Pay attention to the language. Now, I'll get to the Fed meeting in just a minute here in terms of rates. As we get to Thursday we have a fair amount of, I'd say, B-grade economic reports happening, but what happens at the end of the day is really important because we have Amazon and Google and Apple reporting at the end of the day. Those are going to be moving the market quite a bit, especially in the Nasdaq. And then, of course, we get back to Friday here with a jobs report. This has been not a huge market mover again, but notice all the Fed speak that we also have. It's bracketing everything as well, too. So the market's going to be going like a trampoline, I would imagine, over the next 3 days, responding to and trying to anticipate some of these reports. Now, I like this site here with talking about the Fed report because what this does is basically discount what the market is baking into the probabilities for tomorrow's policy release. And right now, the market is saying that there's a 95.9% chance that rates are going to stay pretty much where they are right now. And there's only a 4% chance that we're going to see them raised a quarter point. Very much doubt that Yellen is going to do anything in her last official function. But here's the point. We have to read between the lines of what's going to occur in that release. It's not going to be the fact that she's not going to raise rates. It's what she's going to say about the forward look on raising rates. And this is what's going to happen literally in milliseconds, is that the release is going to be parsed and the market will react in a big way. So this is coming up again tomorrow. If there is any news into that is already not priced into the market. In other words, if they come out of left field with something that nobody expects, then you'll see the market react to that. First, probably to the downside due to the uncertainty that it brings. Now, last thing I want to bring up here is the VIX. And we talked about the VIX a couple of weeks ago, and we talked about the fact that regardless of the fact that the market was driving much higher in a parabolic fashion, the VIX was actually starting to print higher lows and higher highs. And today we finally broken out above this trend line. Now that's meaningless unless it actually does something and gets somewhere. You look at a VIX of 14.5 and you're not exactly shaking in your shoes saying, wow, that's a huge VIX, let's sell that. However, what could happen, and let's go back to the S&P, is that we are way overdue for some type of corrective market action. So range expansion like this leads to range contraction, and it will start from the smallest time frames. So eventually what I expect to see happen is I expect to see the S&P into at least a mid-level correction, maybe not even as much as 10%. But I believe this is going to be not as big as what we went through in 2015, 2016. It's just going to be a mid-level correction to begin with. Where it goes after that, frankly, I don't know. It doesn't matter right now. But let's talk about how this transitions. Now, reversals happen from the inside out. The monthly chart is not going to sit there and reverse. What happens is the smallest time frames start the reversal process. So let's talk about this for a second. What's going to happen first is that if we do have some kind of unpriced in information, it could be any catalyst, which causes some downside, okay? When in doubt, palms out, the selling will occur, right? Palms out is the old floor trader signal for selling. So we could see a very rapid move down here, and this is going to catch a lot of people by surprise if we actually do see a revisit of something as deep as the 50-day moving average. Seems kind of hard to believe that we say that that's a deep test, but right now that certainly is the last breakout area and a deep test. This is not a reversal. So what happens is we start off this move by what I call the shot across the bow. And it's going to come with a move that really comes out of nowhere to most people. Most people are shocked by this move. We can show a lot of examples of this move. If you want to go back to February 27th in 2007, you can see a great example of a move like this. We can go back to August 24th, 2015. We can see a great example of that type of move, right? But it comes as a shot across the bow. That is only the first move. What comes after that is we eventually will see a bounce. Everybody's going to wipe their brow and say, okay, it's all over. If this is going to turn into something bigger, what happens is the lower high prints at that point, and then the real selling occurs. The real selling will occur, and who knows, maybe we'll even revisit the 200-day moving average. Long overdue. So my point here is that this is going to be based on the fear that we see with this initial move down. This shot over the bow is going to give us a very nice spike in implied volatility. And it's going to be a tradable event, even if this just creates a lower high. That's what we're doing, after all, is we're just trading here. We're not making an investment. We're not going to be buying something at the high to hold on to for years and years. That comes later after the eventual correction. But this is going to be a tradable bottom when this does show up. But don't be greedy with this. The whole idea of this, get in, get your fair share, and get out of the position before the lower high sets up, and then the additional selling kicks in. That's it for today's report. Thanks for listening. We'll see you tomorrow.